Hello friends, myself Dr.Sharnappa SM, Associate Professor, Department of Post-Graduation Studies in Commerce, Government First Grade College, Bidar. Today we have to learn about the accounting system. This is the question paper, Gulbarga University, Kalburgi, 2016 question paper, 15 marks question, accounting related questions. Friends, we know very well in the financial accounting, all the financial transactions are recorded in the books of accounts. It is only the book values, not the market values. The management, it wants to know the real values of the monetary items according to the market value. Therefore, the management, it is considering the monetary items with applying the retail price index for understanding the real value of the monetary items. Before going to solve this problem, we have to understand about the accounting. Accounting means what? Accounting is the continuous process of identifying, recording, classifying, and summarizing all the financial transactions in the books of account in a systematic manner. In the accounting, all the financial transactions are recording in the books of accounts in a systematic manner, and that is to be book value they are recording, not a market value. But the management, it wants to know present positions of the organizations, present values or present net worth, present strength and weaknesses of the organizations. Therefore, the management is applying retail price index on all the monetary items for identifying the strength and weaknesses of the organizations. For that purposes, for relating to that, here one problem is given. The following figures are extracted from the balance sheet. These below figures are extracted from the balance sheet of XYZ company and the government publications. The figures are relating to the current assets and current liabilities. Here particulars and opening balance and closing balances are there. Under particulars, these two are the current assets, cash and bank balance, and trade creditors are the current assets. Loan and account payables are the current liabilities. Cash and bank balance is 75,000, that is opening, and closing is 1,55,000. Trade debtors 2,50,000, 3 lakh. Loans 2,55,000, closing is 2 lakh. Accounts payables 2 lakh, closing is 3,20,000. Here, retail price index is given. Opening retail price index is 250 and closing retail price index is 260. And the average for the year 2010 and 11 is 255. These are the informations. These informations are extracted from the balance sheet. These two are the current assets and these two are current liabilities, opening and closing. With applying the retail price index, opening, closing and average, we have to calculate the net purchasing power, gain or loss on monetary items. Okay, now we can see the calculations of this problem. Here computations of net purchasing power, gain or loss on monetary items. According to that problems, here we are taken the particulars and monetary book values. According to the problems, the book values of the current assets and current liabilities, and here monetary value after conversion factor. It means with considering the retail price index, the monetary values. It is before considering the retail price index, and these are the after considering the retail price index. We have to compare these two, book values and market values, whether the companies are gaining or loss. We have to understand. First, we have to take the monetary liabilities. The monetary liabilities, opening value of monetary liabilities is total monetary values. See, opening values total 4 lakh, this loan and account payables 4,55,000. 4,55,000 here we are taken. And closing value of monetary liabilities. You see here, closing value of monetary liabilities. These are the closing 2 lakh plus 3,20,000, total 5,20,000 minus 4,55,000. 5,20,000 minus 4,55,000 is equal to 65,000 is the closing value of the monetary liabilities. Here the total monetary liability is 5,20,000. Now we have to convert these book values into market values. For conversion purposes, we are having in the problem, it is a retail price index closing and opening. You see here retail price index opening is 250 and closing is 260 and the average is 255. Here opening value total is 4,55,000 into 260, it is the closing, 250 is the opening. 260 is the closing, 250 is the opening, is equal to 4,73,200. And closing value, book value, it is the book values, and book values we are taken, and closing retail price index is 260, and here we are taken the average because the 65,000 is increased during the year. 65,000 is increased during the year. Beginning is 4,55,000 and 4,55,000, and end of the year is the same. End of the year is 5,20,000. 5,20,000 minus 4,55,000 is 2 is equal to 65,000. It is the closing values. It rises during the year. Therefore, average price index we are considering for calculating the closing value of monetary liabilities is equal to 66,275. These are the beginnings book values. These are the book value. These are the market values. Market values is higher than the book values. Therefore, this is a monetary gain. Monetary gain. How much? 5,39,475,000 minus 5,20,000. 19,475 is the monetary gain. If we are here, it is how it is the gain means here. If we consider a market price, we have to pay more than the book values. Here book value is only payable book value is 5,20,000 and actual market value is 5,39,000. It means 19,475 should be paid if we are considering the market price. But we are not considering. No? Therefore, this much is the gain. This much is the internal gain of the organizations. Now we have to calculate the monetary assets. Same opening value, total, and closing value, book value, closing book value. see how the opening value is 3,25,000 and 1,30,000 means here this opening value 2,50,000 and 75 3,25,000 and closing is 4,55,000. 4,55,000 minus 3,25,000 is equal to 1,30,000. Here opening value of monetary assets we are applying the price index is opening, that is 250 into 260 into 3,25,000 into 260 divided by 250 and 1,30,000 into 260 divided by 255. Here 3,38,000, here 1,32,550. Total value, monetary value after considering the retail price index is 4,70,550 and book value is 4,55,000. It is a monetary loss because the book value is 4,55,000, but we are considering only 4,55,000, but actual value of that assets is 4,75,000, 70,550. Means here we are showing undervalue of the assets, undervalues than the actual values. Therefore, it is a monetary loss. 4,70,550 minus 4,55,000, this one is equal to 15,550. This is the monetary gain, this is the monetary loss. And you have to deduct this monetary loss from the gain, you will get the net purchasing power monetary gain. Net purchasing power monetary gain is 3,925. Okay, thank you.